Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance and filings for you. Some companies tell you how great they are. We read the paperwork to see if it stacks up. This filing from Plains All American Pipeline LP, or PA, is their quarterly report. It is like a progress checkup for the business. We are going to dig into the numbers to see exactly how they are doing. Let's get started. Before we dive in, if you appreciate getting straight insights from these company documents, make sure you are subscribed. We also have a Discord community linked in the description below, so join us there to keep the conversation going. So Plains All American Pipeline LP is basically a giant in transporting and storing oil. Think of them as the highways and storage facilities for oil across North America. They make money by moving oil and gas liquids from where they are found to where they need to go. This report covers the 3 and 9 months ending the 30th of September 2025. Let us look at the company's financial snapshot on the asset side, meaning what the company owns, things like cash, money owed to them by customers, and their massive pipeline network are listed. Their property and equipment, which is mainly their pipeline infrastructure, is valued at about $14 billion after accounting for wear and tear. That is a huge amount of physical stuff. On the other side of the balance sheet liabilities and partners' capital, we see what they owe. They have close to $5.4 billion in short-term debts and over $9.7 billion in long-term debts. Their cash on hand shot up significantly to $1.18 billion from $348 million. That is a big jump, likely to fund upcoming transactions or just to keep a strong reserve. And those senior notes I mentioned, the long-term portion, are quite substantial, sitting at over $8.3 billion as of the 30th of September 2025. This is a key figure to watch. Now let us talk about who owns the company. They have different classes of owners called unit holders. The series of preferred unit holders represent over $1.2 billion worth of claims on the company. Moving on to how the company performed financially, this is the income statement. It shows their revenues, costs, and profits. For the 3 months ending the 30th of September 2025, total revenues were $11.578 billion, down slightly from $12.456 billion in the same period last year. A big chunk of that comes from product sales, which were $11.15 billion in the latest quarter, down from $12.021 billion a year ago. This indicates lower commodity prices impacting their sales value. Looking at the longer 9-month period, total revenues were $33.698 billion, down from $36.854 billion. Again, lower commodity prices are a major factor here. Their operating income, which is profit from their main business operations, for the quarter was $484 million, up from $196 million last year. That is a healthy increase. For the 9-month period, operating income was $1.08 billion, up from $883 million. This suggests their core business operations are becoming more profitable. Finally, the bottom line net income attributable to PAA for the 3 months ended the 30th of September 2025. This figure stands at $441 million, a significant jump from $220 million in the same period last year. And for the 9 months, it jumped to $1.093 billion from $736 million. This is a strong improvement in overall profitability. This statement shows other income and losses that are not directly tied to their main operations. It is a little technical, but basically tracks unrealized gains or losses on things like currency exchange rates. As of the 30th of September 2025, they had a total accumulated other comprehensive loss of $941 million. This figure is composed of different parts. The derivative instruments portion is showing a loss of $31 million. Now, let us talk about cash. This is the statement of cash flows. It shows how cash is moving in and out of the company. For the 9 months ended the 30th of September 2025, they generated $2.15 billion in cash from operating activities. This is up from $1.763 billion in the same period last year. That is a good sign. Looking at just their ongoing business operations, cash provided was $1.836 billion in the 9 months of 2025, up from $1.597 billion in 2024. However, when we look at investing activities, we see a big outflow of almost $1.831 billion. This is mainly due to acquisitions, meaning they are buying other companies or assets. This acquisition spending alone was $865 million for the 9 months of 2025. They are actively expanding. Then there are financing activities, which involve debt and stock. They borrowed a lot more in 2025. They issued $2.246 billion in new senior notes. This large amount of new debt, coupled with other financing activities, resulted in a positive cash flow from financing of $500 million in the first 9 months of 2025. 2025, a big change from a negative $330 million in the same period of 2024. They are clearly using debt to fuel their growth and investments. This statement basically tracks the ownership stakes in the company. They show changes in series of preferred units and common units. The number of common units outstanding increased slightly. Notably, they repurchased a significant amount of Series A preferred units, reducing that category by over 12 million units in early 2025. This suggests they are restructuring their ownership or perhaps retiring a specific class of units. They paid out distributions to their preferred unit holders. For series of preferred units, the distributions were around $36 million per quarter in 2025. And for common unit holders, they paid out $180 million to public unit holders and $88 million to AAP for the quarter, totaling $268 million. This shows they are returning cash to their investors. Now, for some context, A is a major player in oil and gas midstream infrastructure. They connect producers to demand centers. Their business is organized into two segments: crude oil and natural gas liquids, or NGL. A major strategic move indicated here is the pending sale of their Canadian NGL business. They signed a deal in June 2025 to sell it for about 5.15 billion Canadian dollars. This is a significant part of their business, and selling it shows a clear strategy to focus on their core crude oil operations. The financial statements now treat this Canadian NGL business as discontinued operations. Looking at revenues from contracts with customers, the crude oil segment is much larger, with over $11.5 billion in revenues for the quarter from contracts. The NGL segment revenues are much smaller, just $24 million for the quarter. This highlights where their main business activity lies. They have a lot of inventory. As of the 30th of September 2025, their inventory consists of crude oil and NGL valued at $184 million. They also have linfill, which is oil that stays in pipelines to keep them full and running, valued at $933 million, and long-term inventory at $227 million. These are significant operational assets impacting their liquidity. Let us revisit the debt. They have taken on more debt recently. Total debt stands at $9.449 billion. In January 2025, they issued $1 billion in senior notes and another $1.25 billion in September 2025. This shows a willingness to use leverage for strategic moves like acquisitions. Now, for risks and potential problems, they are involved in various legal and environmental matters. A big one is the Line 901 oil spill from 2015. They estimate the total cost related to this will be around $870 million. While they have insurance, they have only collected a portion of that. This is a long-running and costly issue. They also had a smaller crude oil release in March 2025 on their Line 48 pipeline. The estimated cleanup cost is about $20 million. These environmental issues are always a concern for pipeline companies. Back to their business segments, the crude oil segment is clearly the star, with segment adjusted EBITDA showing $593 million for the quarter. The NGL segment, on the other hand, posted a loss of $10 million for the quarter. However, remember the Canadian NGL business is being sold. The crude oil segment's performance is strong, with earnings up. This is due to higher volumes, contributions from new acquisitions, and tariff increases. Field operating costs decreased, mainly because some costs related to the Line 901 incident were recognized in the prior year. The NGL segment's performance is less impressive, showing a loss. This is largely due to overhead costs that are not directly tied to revenue-generating activities within the continuing NGL operations. The company has been very active with acquisitions. In January 2025, they acquired Ironwood Midstream for $481 million. Then in the second quarter, they acquired Black Knight Midstream for $59 million. They also increased their stake in Bridgetex Pipeline. And the biggest news on acquisitions is the purchase of a majority stake in Epic Crude Holdings, which owns the Epic Crude Oil Pipeline. This deal closed in late October 2025, cost around $2.9 billion. This is a massive strategic acquisition that significantly expands their reach in the Permian and Eagle Ford basins. They are exposed to market risks like changes in oil prices, interest rates, and currency exchange rates. They use financial tools called derivatives to manage these risks. For example, a 10% change in oil prices could affect the value of their commodity derivatives by about $27 million. For currency exchange rates, a 10% move from US dollars to Canadian dollars could impact their foreign currency derivatives by a much larger $325 million. This highlights the significant exposure they have to currency fluctuations, especially with the sale of their Canadian business. Plains All American Pipeline PA is making some very bold moves. On one hand, they are divesting their Canadian NGL business and focusing on their core crude oil operations. This is generally a signal of smart strategy, shedding less profitable or more volatile assets to concentrate on what they do best. The numbers show increasing profitability in their core operations with higher operating income and net income, which is always good to see. Their cash flow from operations is also improving, which means they are generating more cash from their day-to-day business. However, they are also taking on a lot of new debt. Their total debt has grown significantly, and they are issuing billions in new bonds. This is how they are funding major acquisitions, like the massive Epic pipeline deal. While these acquisitions can be strategic, they also increase financial risk. If the oil market turns sour, or if these new assets do not perform as expected, that debt load could become a real burden. The lingering costs from the Line 901 spill, though managed, are a stark reminder of the environmental risks inherent in this industry. Overall, PA appears to be in a period of significant transformation and growth through acquisitions. They are strengthening their core business and making big strategic bets. The key will be how well they integrate these new assets, manage their increased debt, and navigate the ever-changing energy market. They seem to be betting on continued growth in crude oil transport, and if that bet pays off, they could see substantial rewards. But with big bets come big risks. Alright, that is our breakdown of Plains All American Pipeline LP's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.